From 1991 till 2010, there were a lot of down years, a lot of rough years. 1994, the Fed was raising rates multiple times. Markets were down. 1998 was a Russian fiscal crisis. Markets had a rough year. 2000, 2001, 2002, that's 3 years of the tech bubble bursting. And then the 08-09 financial crisis. If you had held the average stock fund for that entire 20-year period and never paid attention to the news, never made any changes to your portfolio, the average investor in the average stock fund would have had a return of 9.9% per year net of fees for that 20-year period. But the investors in these stock funds only captured 3.8% out of that 9.9%. Now, this gap between that 3.8% and the 9.9% is called the investor behavior gap in behavioral finance. It actually has a name because it's an actual thing that exists over every period of time that we can look at. Investors who follow the news to drive their investment decisions tend to want to buy when the news is great, and they want to sell when the news is bad. And when we say the market's very efficient and it prices in all the available information, when there is great news in the economy, the market's very high to reflect all the great news. When there's bad news, the market's very low to reflect all the bad news. So I'm sure you've heard the saying, buy low, sell high. The average investor tends to want to buy high on good news and sell low on bad news, thereby destroying their potential long-term returns. I would argue that the reason for this is when you're only getting price, stock goes up, you sell, stock comes down, you buy. When you're getting information, good news comes out, stock is up and they're buying. Bad news comes out, the stock is down and they may be selling. So to illustrate this, we want to talk about a study that was done in 1991 by psychologist Paul Andresen in Harvard University, where they took two groups of investors and studied them over a period of time. They both got to pick their own stocks. One group got just price updates on their stocks, whereas the other group got price updates and constant news and information on their stocks. The group that did not get news and information did twice as well as the group that got information. So this is another chart that illustrates how your emotions can have a negative impact on your long-term returns. So this is a study of the Consumer Sentiment Index and the subsequent 12-month returns of the market. And so you can see when the sentiment was down at the bottom, February 1975, market was up 22% over the next 12 months. 1980, market was up 20%. October 1990, the market was up 29%. So in all of these situations, when sentiment was at its worst, over the next 12 months, the market did great. Now, what about when confidence was at its high? August of 1972, next 12 months, negative 6%. March of 1977, next 12 months, positive 1%. The top left of this chart shows you at the 8 sentiment peaks, the subsequent returns were 4.1% a year on average. At the troughs, at the lows in sentiment, the market was up almost 25% over the next 12 months. The overwhelming amount of data shows that you are better off staying the course rather than trying to time when the next bad event is going to be, because 10 years, 15 years, 20 years down the line, with all of its ups and downs, the likelihood is that the markets will be much higher. For more information, please feel free to take a look at our website at www.aireadvisors.com. Thank you and happy investing.